All right, what's up, everybody? I am excited every time I get to talk to Jeremy Potter. I first met Jeremy before he went to Rocket. He was there for 6 years as a senior director of strategy and innovation. So pretty cool role at Rocket. And I remember when he had that role, anytime there was something happening in the industry, I'd be like, Jeremy, what does this mean? Jeremy, remember through COVID? I think you and I talked almost weekly for a few months there.
That's right. Yeah, we would do wrap-ups either late in the week or early in the week to kick it off and say, what can we expect? And it was changing day to day. And so we stayed in a
Yeah.
lot of close contact at that time. Yeah, that's right.
Yeah. Well, first of all, really appreciate the leadership you bring to the industry now in a broader scope. You're one of my favorite people to follow on LinkedIn. So keep up the great work on LinkedIn. Everyone listening, make sure you follow this guy. And today he's a chief or a fractional officer, or by the way, a fractional chief strategy officer focused on policy, product, and innovation. And I look at Jeremy as truly an industry innovator and change agent. So Jeremy, Rocket acquiring Redfin, big news. I've interviewed a number of industry thought leaders on the topic, and I would just love to hear how you think of that. And if you were an executive at an IMB, if you were a loan officer, local referral-based loan officer, I'd love to, throughout this conversation, what does it mean to everybody?
Yeah, for sure. I mean, let's start with the addition of digital to digital partners, right? So, full disclosure, when I was at Rocket, I looked up to Redfin as the search, as one of the search leaders. And obviously, we had Rocket Homes. Recently, they rebranded that to just rocket.com, but they had a digital search platform. So, to me, Redfin was kind of the standard. And the reason I thought that, Dave, was it really was sticky with consumers. I mean, obviously Zillow is, they're the monster that has the most clicks per month, and they're the ones everybody looks to on the metrics side. But I'll tell you, when you talk to consumers, particularly on the West Coast, Redfin was well liked. It was a sticky consumer brand, and we knew that even back then. So I kind of figured Rocket had its eye on something like that. But with all the investment in search recently, especially at Rocket, I just assume maybe the ship had sailed. I don't know. And just watching from the outside. So I do think this adds a very dynamic digital component. From the fundamentals of the deal, I think a lot of people have already said this, so I'm not necessarily saying anything new here, but like even if the digital ecosystem doesn't connect in a really organic way, the lead buy alone was worth it in terms of the competition for up funnel access these days. I think that's one of the things that made the deal make sense to them. Didn't have to come out of pocket with a bunch of cash, and they could do a stock deal to just get as many up funnel access points as they can. So from the Rocket perspective, the deal made sense, even if the kind of digital connection doesn't materialize for a couple years.
And so, just for all the loan officers listening, it's 50 million unique consumers are touching that app, and it's purchase. So when I looked at that, I thought, hey, Rocket One is getting a purchase funnel, which is
Yep.
something they previously haven't been known for. They kill it with refis, but they just got a purchase funnel. And then they also de-risked themselves from all the other platforms. Now they own a platform. I'm sure they still will buy a lot of, Lending Tree and other platforms, but they de-risked. They now control one of the big funnels.
That's right. And I think to your point, what does it mean for loan officers and branch managers to be thinking about? I really focused a lot in my research, particularly with consumers, first-time home buyers, around this moment, this question, when real estate agent asks the consumer, how do we look on financing? Are you pre-approved? Are you good? That's a pretty key moment. That's an inflection point. So historically, let's just talk for a second about where Rocket struggled. Historically, it was a consumer would get a digital pre-approval letter off the website, and as soon as there was a conversation with the real estate agent, are we good? I got my pre-approval letter from Rocket. Let's use that to put in our offer, but let me get you with my mortgage partner, my trusted source, and we'll get you your real financing, so to speak. That's where Rocket would lose a lot of deals on the purchase side, was at that moment between some sort of pre-approval, pre-qualification letter and the actual deal, post offer. And so this, I think, leans into that moment, leans into that friction, and says, if we pump our Rocket Mortgage engine up funnel into a digital search engine, can we overcome some of that friction that we've historically felt from real estate agents? And so back to your question, what does that mean? I think it means moving the support and the conversation with your referral sources as a loan officer higher and higher up in the touch points, getting those opportunities to get the total cost analysis and get your pre-approval letters in the hands of those consumers earlier and earlier with your referral partners, obviously, but even before they have a real estate agent, is going to become that much more important.
So that mirrors identically to the conversation I had with Bruce Gerke, who's head of lending intelligence for JD Power, and all the things they're hearing from consumers is that they want more coaching from the lender before the transaction. Like if you wait until the transaction, one, it's a more crowded, competitive arena, and two, you weren't able to really help the consumer. I also think when you look at the data and the amount of equity that people have, and let's face it, anybody that bought a home over the last 7 years got a great ROI. Like let's say they put 5-10% down, they've got values have exploded, and then they also have a really high interest rate, or excuse me, they have a very low interest rate,
Mhm.
and so it's more important that loan officers are delivering, more. They're using data to get that customer financially fired up.
That's right. I couldn't agree more. And I think one thing we know that all of your LOs and branch managers have probably experienced personally, so I'm preaching to the choir here a bit, is that consumers, based on the work that I did at Rocket and my research since, consumers are notoriously bad at knowing when they're going to go shopping. When you ask them how long you think you'll be in the market, when you ask them, what's your time frame, they tend to overestimate the time frame that they have on their shopping, and they get more excited, as we all know, once they start that search. So if you're looking at a move up client, if you're looking at a downsize client, getting that in their hands early is going to help them, first of all, go shopping and feel more confident, but also then solves for that friction point I mentioned earlier. I know where I'm at, and I can make a decision on a real estate agent or on my search criteria. So that is, consumers almost always say, "Oh, I'm going to be patient," and then we find out they're already under contract within a couple of weeks. So that is definitely one of the keys here.
Would you say that this deal really puts an exclamation mark on the fact that there's a new standard that consumers are going to have? They want convenience, they want speed. Now there is a tip to tail with the largest platform, and Zillow is too. I mean, Zillow is one of the fastest growing mortgage companies, so they've got a tip to tail. When I say tip, guys, I'm talking about search, uh, monthly payment. I mean, those are the things they start searching when they want to buy. They start using the monthly payment solutions online when they're starting to think about finance. That's the tip, guys. And then the tail is obviously closing the loan, but for all the loan officers listening in, where you start the transactions when you write a credit report, or when
Mhm.
they're calling you and they're like, "Hey, we want to make an offer on a home." Uh, that is a really magical point. So, is it safe to say there's a whole new level of standard and customer expectation that the industry needs to execute on?
Yes. Here's why this deal was so different than, say, your traditional competitive threat from Zillow. Consumers know you for what they know you for, and it is actually really expensive to change that. And so Zillow is known for search. They're not really known for the end-to-end solution yet. And they're spending a lot of money to try to change that, but they're not there yet. And so they still have handoffs to agents. They still have the lead gen revenue. And clearly, they're trying to capitalize on end to end. But Redfin is known for search and Redfin is known for digital. And so Rocket is known for speed and is known for financing. And so I think that's what you're getting at this key point, which is if Redfin is known for search and digital and Rocket is known for financing and digital, putting those two together is really powerful. And that's different than Zillow spending all this money to try to like change the consumer's perspective beyond search. And so what that I think is the first point, kind of big macro market point. The second point you made is consumers, and you've heard me say this before, but for everybody listening, what we used to say at Rocket, and it's more true than ever before, it was true in your last conversation with Bruce from JD Power as well. Consumers want what they want when they want it. And that's the expectation. If I want to talk to somebody, I want to be able to talk to somebody. If I want to chat with somebody, I want to be able to chat with somebody. If I want no interaction and I want as many digital tools as possible, that's my expectation. We all know that it's very hard to cater to everyone. That's the thing they tell you not to do when you're a startup, try not to cater to everyone. So hear me say this. This is different. What I'm talking about is different than trying to meet every customer profile in the market. I'm talking about just the tools that you use to scale yourself, that you use to communicate, that you use to connect with your referral sources and with your consumers. This says to me, as a loan officer, as a branch manager, I have to have multiple touch points. I have to have multiple ways that my customers work with me because their expectation is I can get access to the information I need, the data I need, and the expertise I need on demand in whatever format, these 1, 2, or 3 different ways. So I just think that the Redfin Rocket relationship really highlights this access point and multiple touch points in the market. I think if you talk to Rocket, they wouldn't even see any conflict across the customer experience or channels with this acquisition. Like the industry might disagree with that, but the way Rocket sees it is we don't have conflict. We have this way to reach us, this way to reach us, this way to reach us, and that's across retail, that's across wholesale, that's across digital, that's across the phone. And so for Rocket, to them, it was a very organic, however you want to do business with us, game on. And I think for competitors, for loan officers and branch managers, it becomes, all right, I just know I need to meet that customer expectation in a couple of more dynamic ways, but it doesn't change the expertise I bring to the table. It doesn't change my brand. It doesn't change how I interact. There's tools in the toolkit I need.
So let's do this. Let's go through a process where you are a fractional chief strategy officer for an IMB. And let's just make up a number. There's hundreds of loan officers with this IMB. Let's go through the checklist of, whether you're a head of production or a CEO, what do you need to make sure that you're doing to support your loan officers through this shift in the market and these new standards? And you froze up on me, Jeremy.
Yeah, Dave, the way I would start is thinking about what is the entry point that you have, particularly from your referral sources or from your book of business. And that entry point is as early as you can intervene with a tool. And that can be obviously if you have the existing relationship, so the move up or downsize client we were talking about earlier, I would immediately be thinking about how do we get pre-approval in their hands as early as possible? Can we send them a proactive pre-approval? So what tools do we have? As you've noted before, consumers want to be able to interact with their options, with their total cost analysis. So how do I take what I already know about them and get them and get the pre-approval, get that proactive link in front of them as early as possible? And so the first thing I'm thinking proactive and early intervention. Those are two themes that I'm talking to my product team about. I'm talking to my sales team about. How do we do that? For
Okay,
first-time home.
hey, real quick. I want to connect a few dots, make sure everybody connects as I see it. So first of all, I think there's two things in terms of getting early. There's first of all getting that total cost analysis in the hands of the consumer as soon as possible and using data to do that uh, clearly. And then also making sure that when your loan officers, I use the term speed to need versus speed
Mhm.
to lead, like just getting to the consumer and having a conversation first, very important. But what's even more important is getting to the needs of that consumer first. So getting there first and then actually delivering a need-based presentation. Is that what the industry needs to do?
Exactly. And I think, Dave, a lot of people, especially at IMBs right now, tend to focus on how to do that. That's where you start to hear about AI and things. I think AI is an incredibly powerful tool, but I think it's the how, not the why. The strategy is what you said. How you execute on that strategy then can become the different ways in which you as an organization want to do it for differentiating reasons or cost reasons or whatever. But the why behind it is the key. And then getting your folks on the same page. This is why we're going to do this, how we do it. Then we can figure that out with budgets and timelines and the tools that we need.
How do you, when you, if like an executive team was listening to this, there's this news, there's these things, give us a process of how they may go about, getting clear on the strategy. Because I just feel like a lot of executive teams are being very reactive, and like, they know they need to go digital. They know their loan officers need to be advisors and coaches, but there's not hey, we're executing a strategy. It's like, oh, let's do this. And oh, that sounds like it works in our head. How should these IMBs go about documenting strategy? Obviously, you did it, help Rocket do it, and I would just love anything you're willing to share from a framework. And what should they all do?
When I come in, one of the key questions I ask first is what level of uh, discretion does your regions, branches, or organization have? So when you say strategy, how much can a branch or a region determine certain tools or certain strategies themselves versus we are going to do this as our brand and our flag? And so I think that's a key question. And that does change how much resources you have and who can employ certain strategies. Let's say you're an executive looking across and saying, we know we want to take an outsized share of purchase over the next few years. We know we're good at it. We know our regions well, and we can do this consistently. Like we can do it across all of our footprint. I think the next question then becomes, what do we already have? Have we done an analysis of what are the capabilities of the tools we already use? Who's using them well? And what does it say about our data that says, okay, we actually have the capability to a good example of a capability, just to be more specific, we're servicing our own loans or we're not. Okay, that's step one. Two, regardless, what is the platform we use to get data out of the system to know where they're at? Right. And to your point, once you know that, bringing them back around and saying, okay, we know this about our portfolio or our recent clients. We know our footprint really well. So now we can say our systems are already in place for a proactive outreach campaign on now's the time to downsize, now's the time to move up. Did you know this about your market? All the different things you can do from a content perspective. So how much freedom do you want to give across your footprint? What tools do you already have in-house? And what does the data say about the capability for you to already do that without having to change anything other than the approach that you work with your sales team and that you cascade down through your footprint?
Love that. What are you hearing in terms of the movement of call it big distributed retail P&L model? Hey, you've got to use our LOS, you got to use our pricing engine. There are certain things that you need to use to manufacture loans. But what do you see as just a trend in the market in terms of lenders really helping standardize the whole experience? I mean, it's not just the rate and closing the loan compliantly and in a way that can be sold on the market. it's helping your loan officers win. What are you seeing out there in the market? Are you seeing a trend for more training, more coaching, helping loan officers do things right?
Yeah, I mean, certainly getting more engaged. I am seeing probably two or three trends we want to talk about. One, there is a trend that we are going to have more connectivity between the brand and the home office or the executive leadership, sales leadership, and everyone else. That we're going to try to bring more. Let's start with brand consistency first. Second, cost really drove a lot of the consolidation of technology partners and vendors. So it was really about cost. Hey, we can't keep doing this. There are still pockets where if you want to spend your money on it out of your P&L, we may be able to accommodate that. But for the most part, we're seeing sort of what you said, which is a consolidation of the primary platforms for particularly LOS and product and pricing, things like that. Lead gen is also tightening up where those leads come from. Now, that's slightly different than distributed retail, but we're starting to see that trend across everything. And then third, we always hear a lot about consolidation, and I'm confident your audience is like, I don't need to hear about it again. What I like to say that's different this time around is I don't think we're going to see consolidation at the company level. I think we're going to see consolidation at the industry participant level, which means the bottom performers in the real estate industry, the bottom performers in the mortgage industry, the bottom performers in the title industry within their companies are at risk. Those companies are not at risk. So we're actually going to see like loan officers going away if they cannot produce at a certain level, and the big loan officers getting bigger. So the consolidation we'll see will be within companies, not of companies. And so if you are watching this and you're a top producer or you're an executive, Dave, that you mentioned, who's trying to create top producers, the resources are flowing there. That's where people are investing because they are not willing to bring along sort of that bottom part of their organization. That's where we're going to see a ton of momentum over the next year or two.
Yeah, I'm seeing that same consolidation to the point where you're either going to lead a team or you're going to be on a team, and that's where the market share and the people that are leading successful, profitable teams are delivering a highly technology solution for the consumer. They're getting to the consumer earlier on. They're consistent with delivering some type of an annual review process. They're delivering more than a fee worksheet. They're showing people how to solve complex problems like, hey, you qualify to move up, and look what wealth will look like. So let's close out because you're also the director or one of on the board of directors for First Home IQ, and you know a lot about the types of products coming to market. Let's talk about just affordability in 2025, and let's just talk about the first-time home buyer opportunity. How do you see it in 2025 for the industry?
Well, it's not getting any easier for first-time home buyers to afford or buy a home in 2025, certainly, if not the next year as well. And I think there's a couple things that this is really meaningful to not just the work First Home IQ does, but the work that your audience is thinking about. One of the hardest challenges we're facing right now is how do you manage incentives and particularly manage the economics of how long you work a lead? How long you work with a first-time home buyer. So the more you can bring in partners and tools that continue to support you and your brand, but nurture first-time home buyers through that long process, the better you can manage your own incentives and your own economics, because this industry has never been good at figuring out how to afford to work with a first-time home buyer for years, right? You mentioned it earlier. We see that competition for the lead become really fierce once that lead is active in the market. The reason is most people haven't figured out a way to extend their touch, their reach, and their influence beyond 90 days, 120 days out. And so the more you can do that using partners and technology, I think makes you more resilient with first-time home buyers in this market. There will be homes to buy. I mean, when you look at the Fannie Mae forecast, when you look at the MBA forecast, life events happen. There's no fewer than 4.5 million transactions. There's usually no more than 6 million transactions. This year will be at the bottom end of that, somewhere in the low 4 million transaction range, and you're competing against cash in many cases. So what percentage of those deals get to the IMBs? I'll tell you two things I heard recently. One, the percentage deals that are all cash is going up and up, as we know. So it's going to reach potentially 40% of all purchase transactions this year. So that means you got to be focused on tools or flexibility that helps your move up buyer, that helps your downsize buyer manage their debt, manage their the tools in their toolbox. And then two, I actually heard what I thought was some pretty bad advice from someone on stage at an event who said, don't send out a link to digital workflows or digital tools because you're playing into Rocket's game plan. You're playing into Rocket's world. I disagree with that completely. I think you have to extend your reach using partnerships and technology earlier in the funnel. And to your point a second ago, stay consistent with showing the insights, showing the expertise, and showing the story that you've built with that customer along the way. I think technology decreases your exposure to competition and to cost, right? So you can work with leads longer because you have technology. You can work with leads longer because you have nurturing partners, educational partners, and you use those tools and you use them right. I believe those leads come back to you. Those leads do not get poached when they go shopping because, as I said at the outset of the conversation, when that real estate agent partner of yours says, are we good on financing? The answer will be yes, and you'll move on to offer. So if you are there at that moment, when they start that process, however long it takes, you use technology and partnerships to decrease the cost and the exposure you have to competition. When the real estate agent asks your first-time home buyer, are we good? The answer is yes, and you move on. You never lose that
I
lead.
mean, let's talk through a few of these slides. So, you know, to me, the two top opportunities of 2025 are being able to be uniquely valuable to the move up borrower. And I
Mm-hmm.
do think, guys, that's the alpha because you want
Yep.
to, realtors are still your partners. And when you can actually be valuable at helping a move up buyer go, you know what? I'm going to list my home and move up. Or I'm going to rent out my home and move up. If you can actually be a partner that gets that consumer financially fired up, you've just become really valuable to agents. And then first time buyers, there's a lot of them. And if you can be really uniquely valuable at getting that first time home buyer financially fired up, that you know what, I'm going to buy and I need to buy now and I need to make whatever offer I need to win, like you become really uniquely valuable. So I'm with you, giving people, whether it's a PDF, whether it's just an email with rates, here's your rate, here's your payment, here's your cash to close. Guys, that's a transaction. And you know what? Rocket and all these online lenders, they could do them faster and they could do them with a lot of convenience and their pricing is really sharp. So I think, going forward, you need to make coaching at scale approachable with technology. And so our philosophy is, first of all, be able to show someone who wants to buy before they sell, like, hey, you could get a bridge loan, and this is what it looks like. And then you can buy that house and refinance it, and this is what that looks like. And then you know what? When rates come down, you could do a refi, and this is what it looks like. Like you need to help people solve complex problems. Or for that consumer that's got a 2 to 4% rate, you need to be able to show them that, hey, this is what your current situation looks like. And you know what does go up over time is equity. And so like look what your net worth would be in 5 years, 7 years if you moved up. Like you've got to show them that. One more case study I want to show you and then get your feedback, Jeremy. You mentioned cash. Whether people are paying all cash for a home or people just have a lot of equity and so they can put a big down payment. This is a good example of where a loan officer said, hey, you could put $1 million down, but what if you put $600 down and you left or 600,000 and you left 400,000 with your investment advisor based on how it's performing, look at your net worth in 7 years. You know, they're using some cash, but they're also, showing that consumer how to be smart about their money. So I feel like that's a new standard that consumers expect, and that every executive needs to get their loan officers, delivering better experiences at the point of sale. Any thoughts on that?
I couldn't agree more. That is spot on. Not only is it the ante to play to get in the game that you just described, here's what I would say. I talked a minute ago about resilience for competition. There's also resilience in terms of innovation. There's being dynamic. And what you just described, we've seen over the past year or two, HELOC marketing and HELOC markets doing better and better, right? Everybody's got a HELOC offering and they've seen it. Your point, though, about how you use cash and how you use liquidity is what consumers expect. They expect you to be able to talk them through. Well, what if I use this tool? What if I use this tool? And guess what? We're going to see new tools coming on the market over the next couple of years. There's a variety of macro reasons why. One is the regulatory environment's changing. The policy environment in DC is changing. So we may see more private capital players. We may see even the GSEs doing some different stuff that requires private capital to come to play. But also, by the way, the equity market is so big now, 36 trillion, 38 trillion, depending on which measurement you use. You can bet people are looking at that from a structured finance perspective to say, how do we get in the game with new types of mortgage products? When you use the equity cash analysis that we just saw, you're better positioned when your lender rolls out a new product, when the market rolls out a new product, to be able to say, hey, we got a new product here. Let me tell you how it changes your cash position. Let me tell you how it changes your equity position. And when I mentioned earlier, you want to have more tools in the toolkit, you basically are prepared for that when you think this way, use these tools, because we know it's coming. It's just the nature of markets. And so you want to be ready. So I think you're exactly right. This is the ante to play, and it will be better positioned for anything that happens over the next 18 months. You can handle it because it goes right to this conversation for sure.
Yeah. Yeah, no, I couldn't agree more. And so for every loan officer listening to this, this is a slide that I use a lot when I'm having strategic conversations with lenders is, historically lenders have competed on price, speed, convenience. And if you're local, you're referral based, you need to compete based off of coaching and the advice experience that you give at the point of sale. And so I highly recommend you guys adopt that. Hey, before we wrap up, I don't know what the chances are to seeing Fannie and Freddie privatized right now. And I don't want
Mhm.
to get into a whole conversation on that. You're probably an expert on that. And we could hold a whole podcast on that. But there's
Yeah.
also been talk that Fannie and Freddie going direct to consumer. And I would love to know, what do you think the odds of Fannie and Freddie going consumer direct are, and really being a threat to, IMBs, brokers, the local originator. Any thoughts on that?
Sure. I think there's a big misunderstanding about what capabilities they have to go direct. So to be clear, Fannie and Freddie cannot go direct with their logo and their tools and then place a loan or make a loan. That cannot happen because the charters in which they were created may make sure that that cannot happen. Dave Stevens at the NBA used to call that the bright line. They cannot cross the bright line. However, can they take things like first look AUS results, first look LP, first look DU, and put them out in the market under a tools flag or some other way that consumers can then know that they have some GSE approval and then go shopping to a lender? Potentially. That doesn't mean Fannie and Freddie are going direct to the consumer, but it does because they'll still need a lender. They'll still have to go shopping for a mortgage, but it does potentially mess with the funnel. I still don't think either of those are very likely, Dave. The bottom line is who touches the consumer has to have the license, the lender license, the broker license. And so you will see that, I think, bright line maintained. We will not see that expansion, but they have tools that are certainly capable of going up funnel and then letting consumers shop. We just haven't seen that happen yet.
Yeah. Well, I also think they're extraordinarily financially successful. with the model that they have. And it's a partnership model. It's, hey, we partner with the industry and we power it. Going directly to consumer is it's a different model. And if you have a model that's this profitable and you've got competencies around it, I would also just say, like, I can't imagine the board or executives saying, hey, that's a great idea. Like it just seems like a different business model.
Particularly at a time when they're trying to focus the GSEs, not expand them.
Correct. Okay. Well, I know that conversation's come up that you and I share that. So first of all, if anybody wanted to get in touch with you, clearly they should follow you on LinkedIn, but what are the best ways if someone wanted to hire you as a speaker, someone wanted to interview you for a podcast, what's the best way to connect with you?
Yeah, I do love LinkedIn, so don't hesitate to use that for my messages, and you'll find me out there, working on what's next. I also try to make my email and cell phone easily available. I'm just jeremydpotter@gmail.com, but LinkedIn is usually where you'll find me. If you do have those big GSE questions, kind of those big industry questions, I do host a podcast called Housing Insiders, which I'm just holding it up so you can see the colors. I know that Zoom blurs it out, but it's on Spotify, it's on Apple, it's everywhere you find your podcasts. And that's where you can get your Future of Fannie and Freddie stuff for sure. And then everything else, if you want me to come to your event, help out your company, track me down on LinkedIn and we'll get in touch.
Yeah, and Jeremy, has just been a key player in product innovation. So someone that you could definitely get those questions answered, and truly one of the top experts in the industry around where the puck is going from a product perspective, affordability strategies. So Jeremy, any closing thoughts for the industry or anything else you want to chat about before we wrap?
We've definitely covered everything that you need to know to live in this new Redfin Rocket world. I think what I would say is definitely keep an eye on the expansion of those first-time homebuyer programs for things like modular and manufactured housing going forward. Keep in mind those shared equity, shared appreciation down payment companies. Dave, I've come on talking about them before, so we don't need to talk about them again, but I am confident that we're going to see a lot of new attempts to get now product features and products in the market, assuming that Fannie and Freddie are getting smaller. I think a lot of private companies are taking advantage of that. And so that keeps you on your toes. It's only good news for loan officers and branch managers, the way we've talked about. But I think product innovation is pent up a bit over the last few years, and we'll see that kind of release in the next probably 12 months.
And I want to just wrap an umbrella around that, and let's call that creative affordability strategies. And
That's right.
and so house hacking, buying a three-bedroom house, renting out two bedrooms, a first-time buyer buying units, um, multiple first-time home buyers coming together as a partnership and buying units. And so for anyone listening to this, like, be an expert on all those products. And remember, your database is full of people that are moving up and are homeowners. But trust me, every one of them that has kids, a goal of every parent is to help their kids get into homeownership. And so, First Home IQ has some great content to promote to your database. Whether it's a family with means that can actually help with the qualifying and the down payment, or a family who doesn't have means, there's never been more down payment assistance programs and creative strategies to help people get into homeownership. So be an expert, everybody. All right, Jeremy, you're awesome, brother. I really appreciate you. It's been a great conversation. Uh, let's keep communicating with each other on LinkedIn, and I'm looking forward to our next podcast, man.
Dave, I'm grateful always for your time, and getting a chance to talk to you always fires me up. So thank you. And really glad to talk to everybody. Let's go.
Let's go.